This is horrifying. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a financial crisis is imminent as a severe contraction in the money supply is now telling us what we've known to be true is that we're going to see an entirely second round of bank failures. I'm going to show you in the data that we just got why this is going to happen and how the banks will be unable to escape this no matter what the policymakers do. And we're also hearing from small business owners who are starting to panic as demand is outright crashing. We're going to make the case of why things for small businesses are going to get far worse before they get better. And believe it or not, central bankers think they finally figured out what caused all of this inflation and why I think they're complete idiots. Let's over to the St. Louis Fed, where he picked today's story up with this chart here about the money supply. Now, why the money supply here is so important. Now, you don't see this being caught up in the mainstream news. And the reason you don't is because a lot of people don't understand it and why it's very relevant. So in a debt-based economy, which we have, you have the expansion of debt, which causes the expansion of the economy. But one really key part of this is not only do you need new debt to pay off the old debt, but you need new money to be created to pay on all of the debt. So as long as the money is expanding in the economy, as the debts are expanding, well, then the two work out just fine. Now, we know based on the data, there's never enough money to pay off all the debt, and that's not what we're looking for. We just need enough money to continue to pay on the debts and to provide people all the income and discretionary money they need for the economy to continue to grow. Now, one of the challenges we see is when you see a contraction in it, it suggests that money is being destroyed. Money is created when commercial banks lend. It's destroyed as people pay back the principal value of their loan, not the interest, the principal. So when you see a contraction in the money, it's telling you something very serious is happening. In the past, when we see a slowdown of the expansion of money, it can trigger a financial crisis, which is why when you see these contractions in the chart, they are exceedingly rare. In fact, I believe this is only the third time in history, and you'll note that since at least I've been alive, and most of you watching this show probably been alive, that we haven't seen one unless you were actually born back during the Great Depression. This hasn't happened. Now we see a 4.6% contraction in the money supply over a year ago. So when you start to equate this as the fact that we have a huge mountain of debt that has to be serviced because, well, we have a lot of debt, we need enough new money growth to be able to do that. So as you see a contraction, usually bad things happen, but does it show up in the charts? Well, not so much. Because one thing people will question is, well, must be the Fed that controls the money supply, and this is a huge myth. The Fed doesn't control the money supply at all. They don't create money. They don't destroy money. They can just raise and lower the federal funds rate, as you're seeing here, and there's not really any correlation between the two at all. They can raise and lower their balance sheet, but, well, QE is not money printing any more than QT is money destruction. But a lot of people point to the money supply and say, well, it has a very strong link to inflation. And well, that too isn't true. You can look at these two charts. Now we have the money supply on a year-over-year rate of change against the consumer price index, that's shown in red. And you really actually don't see much of a relationship here. You can find them, you can move the charts around. But the reason you kind of think the notion that, hey, if the money supply is contracting, inflation has to come down. Well, it makes sense. And one simple factor is if you lose your job and you go on unemployment, you make less money. So you spend less. Inflation comes down because if enough people lose their job and go on unemployment, their discretionary spending falls. It impacts the broad economy. So kind of the same notion here you're seeing in the money supply. Hey, it's contracting, so money is disappearing. There's no way prices can hold up because there's not enough money to maintain demand. So there's some truth to that, but you don't really see that relationship show up in the chart that much. But what about financial conditions? Well, you would think that if the money supply is contracting, well, financial conditions would really start to surge higher as we see pain in the financial system occurring. And well, we don't really see that either. In fact, we don't really see any sort of relationship here at all, because you can go back to the global financial crisis. You can see the money supply was rising at a time as too were financial conditions and stress in the system. So that doesn't really help us at all. So why do we think this means that banks will fail? Well, it's very simple, because what is the issue that banks have had? Deposits. And so when you look at the fact that deposits are really the lifeblood of what we need in the banking system right now. If money is being destroyed and you have all these small, mid-sized regional banks that are just desperate for deposits, well, that means there's less money going around and less money that goes into deposits. And if you have less money in deposits and you have more stress on the system from the Fed raising rates or anything that causes money to shift out of the banks, next thing you know, you face more and more insolvencies. And that's why we see the relationship here between the money supply and deposits at all commercial banks are really starting to matter. And you notice not only do they matter, that's because they're about virtually the same thing. So as we think about this, if deposits at commercial banks are contracting, what does that tell us is happening to those small, mid-sized, and regional banks? Well, it's suggesting that their money, their deposit base is not growing, or if it is, it's not growing that much. So the longer this goes on, the more pain we're going to see in the banks, because what the regulators, what the policymakers should be doing is trying to figure out how to get money back into the banks. Of course, we know they could do that by lowering the federal funds rate and doing quantitative easing. They could undo that overnight reverse repo program. There's a number of things that they can do, but when you start to understand the money supply is contracting is really horrible for the banks, it tells you why we're not long for an all-out crisis of another round of bank failures. And what we're seeing in small businesses, well, they're echoing the sentiment is really bad and then going to get worse. Hear this from Bank of America. They've seen small businesses are less optimistic, and that leads to lower spending. Of course, will make the case why consumers are actually going to drive their spending down even more. But look at this. They're saying that small businesses are feeling less optimistic. In the recent National Federation of Independent Business survey, small business sentiment dropped to 97.4, the lowest reading since January 2013. This was part driven by reported weaker sales revenue and continued pessimism on the economic outlook. The bottom line, if you're a small business owner, this survey is pretty simple. If you're seeing demand for your products and people coming into your store and buying stuff, well, your optimism goes up. And if you don't, your optimism goes down. And it's so bad right now, we can look at this chart and say, wow, it's back at 2013 levels here. But what is really driving this is more of the consumer. Of course, small business owners are just finding out that consumers don't want to spend. But B of A asked the question, why is sentiment important? In general, falling sentiment means businesses are less likely to spend themselves. Now, this would mean on labor and other expansion and anything. In fact, according to their small business owner report, nearly half of 42% of business owners indicated they're reevaluating cash flow and spending. And of course, if you think about what that means, even at your own household level, when your sentiment is down about your income or your finances, what do people tend to do? They start to go through their budget and say, well, I don't really need that anymore. Maybe we can trim that package back. Maybe we start doing this part ourselves. And business owners will do the same thing. That leads ultimately to less consumption and then further exacerbates the slowdown. But why are consumers so important here? Because the trend, of course, in consumer sentiment tells us the pain for small businesses is just beginning. Here we have the University of Michigan Consumer Sentiment Survey. And you know, if you're a regular on the show, we love sentiment surveys because they really give us a pulse of what people are thinking. This we have against advanced retail sales. That is on the right and in red on a year-over-year rate of change. And what do we see? As sentiment falls with a lag, retail sales fall. You see sentiment falling, retail sales slowing and then falling and even contracting. Here you can see sentiment falling. Now there's a bounce back here. Now you get some noise in the data. You see some bouncing around, but what we're seeing is a decline in retail sales, of course, on the back of sentiment, telling us that what's going to happen in these surveys for these small businesses are only going to get worse. It means they're going to further cut spending, and then at some point, if it doesn't turn around for them, the next big thing they're going to do is start cutting back employees, and you start to get that kind of domino effect of what happens in the economy as a little bit of slowdown turns into a little bit bigger of a slowdown, and next thing you know, it starts to accelerate. And here we can see the survey says weaker capex and hiring point to moderation and overall payment slowdown. So we get some validation here. The small business payments are showing signs of cooling, as according to Bank of America's data, total payments for small business client, which includes ACH, cards, wires, and checks, and person-to-business payments, contracted at 8% year over year, and that's a pretty big deal just in the month of April. They do want to note that since payments were elevated a year ago, there are some unfavorable base effects in the figures, but notably, there is still a decline. And within the components, the ACH payments per small business client slipped into contractionary territory at minus 4% year over year, the first negative reading since January 2021. So here we're already seeing now this post-pandemic euphoria. We're supposed to have this major expansion. We're seeing just further evidence of slowdown. We talked about the factory sector, how it's been slowing down, and that yet the services data looks pretty good. But what we're starting to see in the Bank of America data here is that, hey, there's probably going to be a pretty big trend change in that services optimism here in the months to come. And we know that because there's other problems now that these retailers are facing in the midst of the slowdown, and that's their inventories. So here you can see advanced retail sales are coming down, but you look at inventory growth, well, it's still running at somewhere around about 7 to 8% a year in growth. So what we know is that retailers have way too much inventory. They're going to have to cut prices. They're going to have some deflation in there. And if they don't move this inventory, and based on the data we see now, and you notice I've got this green line on the retail sales showing where it contracts at. So we're on the verge of a contraction in retail sales, telling us demand is going nowhere at a time when inventory growth is just astronomical. So you can only imagine small business owners are going to be screaming here in the months to come when they're just loaded to the gullet with inventory, and next thing you know, their stores are empty. It's going to be a huge problem because these small business owners will need to access the credit markets to keep afloat, and all of a sudden things there are drying up. As credit tightness adds to the pressure, BofA notes, last but not least, they say credit conditions continue to tighten for small businesses, adding to expenditure headwinds. Last month, we argued that banks have already started to tighten lending conditions, and recent development also suggests this will continue, if not accelerate. And one thing that should be accelerating is that is your trading account to the upside. We should show you how to use our CTA-Timer Pro. Link in the description below. I'm going to show you here. This is one from our report today. You look at the soybeans, and this is a chart of soybeans. Now, if you're looking for a trade and you don't know how to find something that's low, well, I'm going to show you how our report tells you. This is telling us right now, look at this report on soybeans. This from today, it's been saying, look, you're 100% short on the fast, 100% short on the slow algorithm. Look at this chart. What it's telling you, watch that CTA report. When you start to see a reversal here, or you run your own screens on it, which is great, it's telling you, look, there's a potential upside move here. It gives you a great way to start to find trades that are sitting near their historical low extremes. There's one for you. Be sure to check it out. Again, link in the description below. A bargain price at $30 a month. Because here we have the net percentage of domestic banks tightening standards for commercial industrial loans against the commercial industrial loan data on a year-over-year rate of change. And we've been saying that at some point, we're going to see the commercial industrial loan data roll over. It's right on track. You'll notice anytime you see the blue line go above the horizontal black line, it's telling us that banks are tightening lending conditions. And sure enough, that eventually turns into fewer loans originated. There you start to see it going into the dot-com bubble. There you see it in the global financial crisis. There you see it now. And of course, why is that again so critical? As we started the show out, is new money is created when commercial banks lend. So as you see a slowdown in commercial bank lending, you see a slowdown in money growth, and next thing you know, you face a ticking time bomb, a game of musical chairs when it comes to this debt repayment. And at some point, you start to see delinquencies show up and eventually defaults. Of course, the banks themselves, the smaller banks, had a big problem because they're not seeing deposit growth. Next thing you know, you've got a banking crisis, financial crisis, and a recession all at the same time. But how about the housing market? Well, we have some interesting news here as U.S. mortgage rates rise to the highest since March, slowing demand. And sure enough, it is. We're seeing that applications for home purchases fell 4.3% in May. How about we see the refi applications? They're falling 5.4% from the prior week, contributing a 4.6% drop in the overall measure of applications. Now, as we head into the summer season, this is pretty critical because this is when school starts to get out. This is when families say, look, look, we can move because we don't want to move while our kids are in school. Now we can look at moving. We can go out and buy a house. We need to go get a mortgage. We've been wanting to do this. Here the opportunity is. And what are we noting? A slowdown in demand. And you might recall from a recent show, we talked about how home builders were exuberantly optimistic. I mean, they were off the charts with optimism that people are going to buy. And last month, they had good reason to. As new home sales unexpectedly surged in April as builders slashed prices, here we can note that after existing home sales declined in April, this from Zero Hedge, expectations for an incentive-driven surge in new home sales to slow from 9.6 month-over-month in March to minus 2.6 month-over-month in April, but instead new home sales surged 4.1% month-over-month thanks to a notable downward revision in the data from March. So all of a sudden we're seeing this big upturn, but what I want you to know here, this is the data from April. Remember, the government data is always behind. If this mortgage application data, which it is good, it's accurate data, if it continues to see a downturn in applications, either what this means for the data coming in May is there's either a lot of cash purchases or we're going to see a big decline in home purchase. And sure enough, Zero Hedge nails it with this chart here showing 30-year fixed rate mortgage inverted, kind of upside down here against new one family houses sold. And what do we expect? A decline here. Now going into the summer season, this is going to be outright devastating for the housing market and all the people employed by it, because it's usually a time they see a ton of business. But one thing we do know is central bankers have finally, I know you've been waiting for this, they finally solved the conundrum of what caused all this inflation, and what you're about to see that I think they're complete idiots. Wall Street Journal reports that why inflation erupted to top economists, the best of the best. Well, they finally have the answers, and we're getting one from our former Fed chair and one of our favorites, Ben Bernanke. For 2 years, the debate has raged over what caused the highest inflation since the 1980s, government stimulus or pandemic-related disruptions. What's amazing is that it took 2 years for them to come to this conclusion, when I think we figured this out quite a while ago, because those who actually live out in the economy, they know. Now, two of the country's top economists have an answer. It's both. There you go. I know it's shocking. Pandemic-related supply shocks explain why inflation shot up in 2021. An economy was overheated by fiscal stimulus and low interest rates, even though a lot of people weren't borrowing then. Explain why it stayed high ever since. The conclusion: for inflation to fade, the economy has to cool off, which means we got to send a bunch of people to the unemployment line. So when you start to make sense of this, so you just put a closed system in place and you say, look, here's a limited amount of resources, and we're going to give the people a whole lot of money. And then we're going to tell those people you don't have to work, so we can't create new resources. Well, what's going to happen? They're going to take all that money they got, buy all the resources up, and then they're going to get some more money, and inflation is going to take off. This really wasn't that hard to figure out, but it took them 2 years, and for good reason, because I want you to see that the idea here that the labor market is going to cool off and inflation is just going to come down and everything's going to be happy is not likely at all. Here you can see in this chart the consumer price index on a year-over-year rate of change against the 4-week moving average of initial claims. And what we can note is that throughout history, when inflation comes down, at least in modern history, maybe not back here, but here in the 90s, 2000s, when inflation comes down, you see 4-week moving average of claims is rising. You see it happen over and over and over, and it's happening now. And again, due to the design of our social safety net, when people go on unemployment or other type of benefits like that, they don't have 100% of their pay. They immediately must cut their spending, and that just has kind of a flow out into the economy. As more and more people lose their jobs, less discretionary spending, it all goes full circle. And at the time, many forecasters thought the stimulus could push demand above the economy's potential to supply goods and services. Well, that worked, although a few disagreed. Notably, Secretary Lawrence Summers and Blanchard warned the stimulus was so large it would push the economy dangerously into overheating, which it did. But as far as a legacy of stimulus, which I say we'll never see again, but many people say I'm completely wrong about, we note the pandemic disruptions did eventually subside. Why didn't the inflation fall? Well, the authors conclude is that by this point, the demand was so strong, reflecting the legacy of low interest rates and fiscal regress. The labor market was significantly overheated, with a ratio of vacancies to unemployed up dramatically. Moreover, the initial surge of inflation had an echo. It lifted workers' expectations of short-term inflation, which partly found its way into wages. Look, when you send people home and start to cut off all of their, give them no reason to go back to work because the stock market went up a whole bunch and people hit their, they start to retire. Like, it's only inevitable that this was a perfect storm for inflation. They're still trying to figure out, but it's really simple. We had too much money chasing too few goods because of fiscal stimulus and nobody working. And now we have a problem is so many people retired that we have a labor shortage and effectively wages are rising. There it is in a nutshell. Now you can see Bernanke and Blanchard conclude that because inflation today reflects the too hot labor market, the solution is to cool it off. And as you've just seen, my friends, they're going to cool it off, all right. And that's going to trigger a global recession and a financial crisis at the same time. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.